Hi guys, it's Wendy from Ask The Landlady. I'm here with all the tips and tricks to help you make a profit in real estate rentals. And today's question is, why is everybody moving to the Midwest? I'm a Midwest girl. I love to hear it. Come on, baby. Although it creates more competition. So maybe I should not do this video. Dang it. I'm an ethical landlady, and I would love to talk about all the ways to make money. So here we are. I'm going to read you something right now. This is Zillow's list of the hottest housing markets of 2026. Okay, are you ready? Number 1, Rockford, Illinois, hot place. 2, Toledo, Ohio. Dearborn, Michigan. South Bend, Indiana. Carmel, Indiana. Not Miami, not Austin, not Nashville. Illinois, Ohio, Indiana, Michigan, the Midwest. So for decades, literally decades, the story of the American migration has been one sentence. Everybody from the Midwest is leaving. We're going south, Sunbelt. Factories are closing, nothing up here, bad weathers. We don't want to be there. Why would we be there? All the industry is going down south. That's where it's at. Okay, or the coast, Silicon Valley, blah, blah, blah. Well, the script just got rewritten. And if you're a real estate investor and you have not been paying attention to the Midwest, we're going to spend the next few minutes here talking about it, laying out the risks with some honesty, because the window of opportunity is short to get in, and it's not going to stay open forever, but also the rewards. Okay, so let's get into it. So welcome back to my channel, Ask the Landlady. I hope you've been here learning how to build wealth through being a landlord or landlady. Quick note, the show exists to cut through all the hype and the jargon, the real estate terminology, and just show you what actually works as an investor, to talk about the trends and what's happening, and to answer your questions about being a landlord and trying to manage your properties. So today's topic is something that I've been watching happening. I probably should have done it earlier, but quite frankly, I didn't with the competition. And that's the Midwest migration. But 2025 data is when we really started getting confirmation. This happened, COVID times, when people could start to work remotely. A lot of people went home, right? They were out in San Francisco, but they're like, it's a lot cheaper to be in Indiana with my mom and dad. And those kind of migrations started then. But we didn't know if it was going to sustain, if it was going to settle out, people were going to go back. But 2025 data is in. And so now we have some more data points to actually support the fact that, yes, maybe you should be investing into the Midwest there. So, sorry, my light's not working real well here. So I feel like I look a little dark there. Sorry about that. Tell me in the comments. Does it look terrible? Probably. Anyway, who cares about what I look like? Let's get into the data. Let's get into the information here. So, where were we? Okay. Let's get into this 2025 data that's come out telling us, yes, people are coming to the Midwest, and it is a time. So we've had some flips. Both Minneapolis and Indianapolis have both shifted from outflows to inflows. Like, more people are coming in than we're going out. And we actually have real census data that proves that. It's actually proven about both of those states, and their U-Haul lists for people for moving vans and stuff has actually proven they're having inflows instead of outflows. So here's the trend that should, the piece that should make you see this trend seriously. We actually had, for the first time in 2025, excuse me, great inflows into the Midwest versus out as a whole. Okay, we've never had that till that year. There was more people going out and leaving than coming in, and that was the first time that started happening. Meanwhile, the Sun Belt is actually weakening in some markets. And we've seen that with Florida. Look, those insurance rates, crazy. Texas, crazy. People are like, I can't afford to be here anymore, and they are getting out. So here's, I think, the phrase that I think kind of explains this whole thing perfectly, better than anything else I've read, and that's called the Goldilocks city phenomenon. Remote workers, or just anybody that can't get ahead, that's living on the West Coast or Washington State or Florida and can't afford things, are saying, I want cities that are big enough for the amenities I want. I want an airport. I want restaurants. I want cultural things, but small enough that I can afford rent. I can afford a place. And I really hate this soul crushing traffic, right? New York City, LA, I'm looking at you. So cities of 200,000 to 800,000 are really hitting that sweet spot. And the Midwest has more of those cities per capita than anywhere else in America. So that Goldilocks phenomenon is kind of what's bringing this whole piece together. Okay, so this migration data shows that people are moving, but why? Okay, let me give you the real version, not the Chamber of Commerce version. Number one driver of this is housing affordability. Okay, and March 2026 survey found that 88% of the people who moved to the Midwest said it was for lower housing. Okay, that's 88%. That's a majority. That's pretty much everybody. It's not narrow. That's near consensus. When your median house price in the Midwest market is well under 300,000, that's very appealing when you look at the national average, which is 420,000. That's a huge gap. People on the coast are spending $7, $8, $9, $1 million for their median homes. That's this whole influx of millionaires out there. Everybody's like, oh, there's more millionaires now than ever. Why? Because of their house, and then they don't even have all the equity in it. They're not really a millionaire yet. And so that's a huge difference. If you can be paying under 300,000, that's your number one driver. Second driver is what I've already alluded to. The remote work has made this possible. A lot of people have delved into this. A lot of companies have been able to keep that. And if you've been able to come to a better market because of that, that's made this actually possible. You can go on the internet and find all these stories. A software engineer working in Silicon Valley moved to Ohio to be near his aging parents and to have some grandparents for the kids, and tripled basically his salary in doing so, because he got out of all those high costs on the West Coast and came to Ohio. He didn't do, same salary, but his buying power was so much better coming to the Midwest. So that remote work made it possible. And, with COVID, a lot of people said, I don't really like being so far away from my aging parents and my siblings and my grandparents and my friends that I went to OSU with. I'm going to go back to Columbus, Ohio, right? That also is part of that equation with the remote work. Third driver is climate migration. We've had some crazy climate stuff go down, right? In the Midwest, it used to be we were all escaping because we hated the winters. Well, it's been global warming, whatever, guys. It's warmed up. We're not having as bad of snows and stuff, so people are weathering that out a little bit better. It's not quite such a factor. Meanwhile, you're getting extreme heat in some places in Texas and Florida, and you're having hurricanes, and you're losing coastal regions, you're having wildfires. People are escaping those things and saying, well, we thought those winters were bad, but when we mediate it all, it's not so bad. Plus, we can afford the insurance, which is a big factor there. So there you have it. There's the kind of three drivers there. The low housing, the remote work, and different climate issues have kind of changed over time, making it more palatable for people to live in the Midwest. So what does this mean for you real estate investors? Okay. You guys are saying, great, people want to live in the Midwest. What does that have to do with me? I'm going to buy real estate and make money. I get you. Let's talk about the math, because that's what it all comes down to, baby. It's all about the money, and it's all about your price to point ratio in rent. Okay. Price to rent. And that's where you're looking at whether you can buy something and it will cash flow, right? Because a lot of times you look at a deal and you're like, oh, I can buy this house. It's a $300,000 house, but I can't get enough rent out of it to even pay the mortgage, right? That I've got to pay. So that's a bad deal. So when we look at cities and we look at their price to rent ratio, that's going to be what tells us a lot more. A ratio above 20 means it's a market for appreciation, not necessarily for income driven. Okay. So most coastal cities are well above 25, 30. San Francisco's been uninvestable for cash flow for years. You're buying there for appreciation, not buying for income. However, if it's under 15, it's favorable. You're going to cash flow, right from the beginning. And a place that this happens all day and all night is Cleveland, Ohio. Their ratio has been measured as low as 10 and 11. That means that a property that rents for $1,200 a month might just cost you $130,000, $140,000, right? So with your mortgage rate, depending on how you're purchasing it, reasonable down payment, you can cash flow from day one. And that's what you need and want to do as a real estate investor. So when I hear people saying there's no deals out there, yes, there are, but it might not be in your home region. You may have to look out further afield, and Cleveland, Ohio is one of those places. And vacancy in Cleveland is kept low because they have institution and infrastructure there. They have Cleveland Clinic. They have Case Western Reserve University. There are places that are going to keep families and keep people there. Unlike some cities where everything's leaving, they have that infrastructure. Another place that Zillow is pegged, and I already talked about, was Indianapolis, Indiana. Median home price 272,000, well below the national average, right, which is 420. And your gross rental yields are right there around 9 and 10. So again, another place where you're going to cash flow. The one thing that investors have to be cautious of, though, is that property taxes for the investors in Indiana are higher than for owner-occupied properties. So you're going to want to run those numbers carefully. It's kind of also the case in Ohio. So that's kind of in flux with our property taxes are high as well. So those are numbers that you're going to have to definitely pay attention to on that spreadsheet before you make the deal. Speaking of which, if you need to run numbers for a deal and you're just running them through AI or doing whatever, check out my webpage, askthelandlady.com. I have a spreadsheet that is dirt cheap. I think it's $10, and it will let you create all those different variables, put all those different things in. So you can put in run scenarios from all different houses in the Midwest to see if they will cash flow. So check that out. Sorry about the shameless plug. Okay, let's back to our cities. Columbus, Ohio is another good place. You got OSU. You got several Fortune 500 headquarters. The solid rental yields with that. It's a very Columbus market for years here with houses have been. It's just growing. You don't even need a realtor. Your house is for sale. Oh, it's gone. So that's a market that it's hard to get into, but it's growing, and we still have all that infrastructure. So it's definitely good for people both ways. They want appreciation because it's just going up and up and up, and cash flow, right? So you might want to look at that market. Another interesting one, Pittsburgh, PA, often overlooked, but strong on that price to rent metrics. A lot of people rent there. You got an airport, you've got the University of Pittsburgh, you got UPMC Medical Center, you've got a lot of built-in rental demand that is not cyclical, that is year round. You got sports teams, and your entry prices are very competitive. The catch in Pittsburgh is just sheer geography. If you've ever been there, it is bridge, 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 river, river, mountain, tunnel, craziness. And it makes the neighborhoods kind of hard to understand. So you really need boots on the ground to see what you're getting at, because, your neighborhood will be, like it's going to be wild. So you genuinely got to go there and walk it, and maybe have a really good realtor, somebody in the know to kind of show you that area, so you don't end up with something that's not going to work for your investment opportunity. Okay. Another one I want to talk about, Kansas City, Missouri. Same thing, strong price to rent ratios, growing population, diverse economy. Prices, it's not as cheap as it once was. That's why it's kind of bottom of the list, but it's still there in the market for the Midwest. So those are all the good positives, right? Median prices well under the national average. Your price to rent ratio is strong. Infrastructure not going anywhere. Solid. Good places to invest. But I'm the landlady. I'm always going to mitigate things. I'm always going to tell you the real truth. And that is, of course, there's risks. There's risks in everything. So let's get into those. Risk number one is older housing stock. These places are not new. It's the Midwest, right? We don't have that new construction. When I drive through Boulder, Colorado, new. Florida, new. No, old. That can be good and bad. You have solid brick houses. Pittsburgh, PA, 1920s, 30s, 40s bungalow houses. Beautiful, great, well appointed. So if you keep up with the roof, but you're going to want to check those sewers. Old cast iron pipes are everywhere, baby. So you buy a house for $90,000, you're like, great deal. Well, you may have to put $40,000, $50,000 into it. So those are the things that you need to know as an investor going into that market. Be aware of that older housing stock. There's still places with knob and tube wiring, right, and lead paint. So be careful on those issues. Number two is, and I've already talked about this, the neighborhood variance can be extreme. Cleveland, Pittsburgh, all those things, because the way the cities have been, they're old cities and they've had resurgences in different areas. And you may have had a factory there, but now it's all trendy. But then this area has gotten seedy, and then this one, so finding the markets that are up and coming and not down and going are something that you're going to need to really delve into when you go into those areas. Number three is population ceilings. Not everybody has the trajectory. Like Indianapolis and Columbus are growing. Cleveland is stabilizing. Same thing with Kansas, Missouri might be going down. So the fact that I said, great, we have more people coming in than going out, that could change overnight. So that's something you just want to be aware of. That is a risk that we're taking in those places. That's why if you do choose wisely, choose something near Cleveland Clinic, choose something that is going to always have that infrastructure and be very rentable for you. Risk number 4, it's always property taxes, baby. Always the money, honey. In Ohio and Indianapolis, Indiana, I'm looking at you. It's where you charge us real estate investors more than you charge just single family home buyers, which is crazy and cruddy because who pays for it? The renter, right? So it's just a screwed up, messed up system, but something you need to be aware of. So, and your last risk, I think I already said this, the window is not infinite. This is this narrow place, and you got to be careful because it could change at any given time. So there you have it. My top picks would be for pure cash flow, Cleveland. For balanced play, I would go with Indianapolis or Columbus, Ohio, because you're going to get that long-term appreciation as well as solid cash flow. So there's a little tie there between those two. And if you're just a contrarian, very interesting real estate investor, and patient, I'd say Pittsburgh. It's got a lot of up and coming things coming. They just had the NFL draft. That city and shows up on a lot of trendy markets for having an upsurge, but it is a different market. So that's something to be aware of there. So again, if you're a real estate investor and you're interested in the Midwest, you're not from the Midwest, my caution again is always to get that boots on the ground, visit the market, walk the neighborhoods, talk to people, hire somebody, hire an actual realtor. Don't just go with somebody who's wanting to unload this property on you and doesn't tell you that this is a notorious crack zone drug area, right? Get somebody that will give you the real deal. Hire them to get that information. You pay somebody $400, can be well worth it before you spend $150,000 on a property that you find out is unrentable or is going to be destroyed in a week. So definitely you want to do that before you purchase. And then, of course, run the actual numbers, not just round numbers. Since you're out of your market, you're out of your comfort zone, you need to really run those numbers more carefully than you would even if it's just in your own hometown. Your own hometown, I can wait it out. I'm really close. I can make it great. But when you're far away, you got other factors that you have to consider, probably property management factors, some other expenses. So be really careful when you run those numbers. So here's where I land on this every day and every night. The Midwest is great. I'm here. Everybody should be here. And it is a good time to actually invest here, which is great because we've not heard that in a while, right? Everybody was trying to invest in Florida and buying things here and there, and then all these other crazy things like hurricanes and COVID and stuff hit and insurance rates, and suddenly Midwest is having a moment. So if you've been sitting on the sidelines, if you've been complaining, there's no deals, Wendy, there's nowhere to buy. There is. Check it out. Check out the Midwest. Do your research and check it out. So I want to hear from you in the comments. Are you already in the Midwest? Are you considering it? Are you on the coastal regions? You still think we should be there? Do you think the Sun Belt is the way to go? Let me know. Would love to hear it. In the meantime, check out my books on Amazon, Wendy Myers. I got several real estate books and a forms book. You can buy my forms on the internet too. $20, best money I ever spent. They're already done for you. And you can get them in Word documents, so you can just do them as you want. Or you can get the book if you you want to rip the pages out and copy them. Great, have at it. So check all those out here. Again, hit subscribe so we can keep doing this. Shoot me your comments and your questions. I read every one. I'd love to hear from you. And I hope to see you again next week, where we come back and we try to talk about building that wealth. Build that wealth, make a profit, make money as a landlord or landlady. Thank you. Have a great day.